Every empire this series has examined so far believed its greatest danger came from outside its borders. A rival power, a foreign war, a competing currency, a hostile alliance. History tells a different story, and it tells it with a consistency that should make anyone watching the current moment in America pay very close attention. The Dutch Republic did not lose its position as the dominant financial power of the 17th century primarily because England or France defeated it militarily. It lost that position because its own internal political structure, a loose confederation of provinces that could never agree on unified action, made it incapable of responding effectively once external pressure arrived. The British Empire did not lose its global dominance primarily because Germany or the United States defeated it on a battlefield, even though both world wars accelerated the process. It lost that dominance because the internal bargain between British capital and British labor broke down across decades of strikes, depression, and class conflict that hollowed out the country's capacity to sustain its position, even as its formal empire still covered a quarter of the globe. This is the pattern Ray Dalio calls the internal order cycle, and it is, in many ways, the most important and least discussed piece of the entire framework this channel has been building video by video for the past several weeks. In his research into the rise and fall of empires across 500 years of history, Dalio identifies two parallel cycles that interact with and reinforce each other. The first is the big debt cycle, the rise and fall of credit, leverage, and reserve currency status that this series has examined in detail across its previous chapters. The second is the internal order cycle, the rise and fall of social cohesion, political functionality, and the implicit contract between a society's citizens and its institutions. These two cycles are not independent. They are deeply intertwined, and understanding why requires looking closely at the mechanism that connects them. A society in the early and middle stages of its rise typically exhibits what Dalio calls a healthy internal order. Wealth and opportunity are expanding, even if unevenly. Institutions are seen as broadly legitimate. There is a shared sense, even amid normal political disagreement, that the system is fundamentally fair, that hard work and merit are rewarded, that the rules apply roughly equally to everyone, and that children will generally do better than their parents. This is not a description of utopia. Every society in this phase still has real conflicts, real injustices, real political battles, but there is enough shared trust in the underlying system that those conflicts get resolved through existing institutions, courts, elections, negotiation, rather than through a wholesale rejection of the system itself. As a society moves into the late stage of its death cycle, the stage this series has spent 5 videos documenting in the American context, something predictable happens to the internal order. The wealth gap, which had been narrowing or stable, begins widening sharply for the precise mechanical reasons explored in the video on middle-class wealth destruction. The shared sense that the system is fair begins to erode, because for a growing share of the population, it demonstrably is not working as it once did. Trust in institutions, government, media, the financial system, even basic social institutions like marriage and religion declines often sharply as those institutions are perceived to favor those who are already winning. And then, this is the critical mechanism. Political polarization intensifies, not as a cause of the breakdown, but as a symptom and an accelerant of it. As the economic pie stops growing fast enough to satisfy everyone, the political fight over how to divide a shrinking or stagnant pie becomes more zero-sum, more existential, more resistant to compromise. Dalio's historical data is specific on this point. He has documented that periods of extreme wealth and values gaps correlate, with striking consistency across centuries and across countries with periods of extreme political conflict. This is not a coincidence. It is the internal order cycle expressing the same underlying pressure, that cycle-driven wealth concentration, that the rest of this series has examined through different lenses. The Dutch Republic's 17th century dominance of global trade and finance was built on a political structure that was, in its early phases, a genuine source of strength. The Republic was a confederation of 7 semi-autonomous provinces, each maintaining significant local power, loosely coordinated through the States General in The Hague. This decentralized structure allowed for remarkable commercial flexibility, religious tolerance relative to the rest of Europe, and a merchant class with the freedom to pursue trade and innovation with minimal interference from a centralized crown. This was the foundation of the Dutch Golden Age, the period in which Amsterdam became the financial capital of the world. The Amsterdam Stock Exchange became the first modern securities market, and Dutch trading networks spanned from the Baltic to the East Indies. But the same decentralized structure that enabled this flexibility became a critical vulnerability as the Republic's external position came under increasing pressure from England and France in the latter half of the 17th century. When unified decisive action was required to fund a sustained military response to French invasion, to coordinate naval strategy against English commercial competition, to maintain the fiscal discipline necessary to service the Republic's growing war debts, the confederal structure that had served Dutch commerce so well became an obstacle to coherent state action. Each province jealously guarded its own fiscal autonomy. Holland, by far the wealthiest province, bore a disproportionate share of the Republic's military costs and grew increasingly resentful of the other provinces' reluctance to share the burden. Political factions within and between provinces, the Orangists who favored a stronger centralized stadtholder, and the Republicans who favored continued provincial autonomy, fought bitter internal battles that frequently paralyzed the Republic's ability to respond to external threats at the moment those threats were most acute. This internal fragmentation did not cause the wars that drained Dutch finances, but it dramatically reduced the Republic's capacity to fight those wars efficiently, to maintain unified fiscal policy, and to sustain the public investment in military and naval capacity that its declining relative position increasingly demanded. By the time the Republic's financial dominance had clearly transferred to Britain in the early 18th century, the external military and commercial pressure from England and France had been the proximate cause. But the underlying vulnerability, the internal political structure that prevented coherent, sustained national response, had been present and worsening for decades before the external pressure became decisive. The British case offers an even more detailed and better documented illustration of the internal order cycle, precisely because it unfolded within living memory of modern historical record keeping and economic data collection. The late Victorian and Edwardian periods, roughly 1870-1914, represented Britain's peak as a global hegemon. The empire spanned a quarter of the world's land surface. The Royal Navy was unmatched. The City of London was the unquestioned center of global finance. And yet, beneath this imperial peak, the internal order of British society was already under mounting strain. Industrial Britain had produced enormous wealth, but that wealth was distributed with stark inequality. The industrial working class lived in conditions that, even by the standards of the time, generated intense social tension, overcrowded urban housing, dangerous working conditions, wages that frequently failed to keep pace with the cost of living, even as British industrial output and the wealth of the owning class grew substantially. The period from 1900 to 1912, immediately preceding the First World War, saw what historians call the Great Unrest, a wave of large-scale strikes across British industry, including the 1911 National Rail Strike, the 1912 Coal Miners' Strike, involving over 1 million workers, and escalating violence between strikers and authorities that, in several instances, required military deployment to control. Simultaneously, the suffragette movement was engaged in increasingly confrontational tactics demanding political enfranchisement, and the Irish Home Rule crisis was pushing Britain toward what many contemporary observers genuinely feared could become civil war on the British Isles itself, years before the assassination in Sarajevo set the actual war in motion. The First World War temporarily submerged these internal conflicts beneath the unifying pressure of external threat, a pattern that recurs across history where external conflict can paper over internal fragmentation for a period, even as it often worsens the underlying economic conditions driving that fragmentation. But the war's aftermath brought the internal conflicts back with even greater intensity, now compounded by the economic dislocation of post-war adjustment, by the return of millions of demobilized soldiers to an economy that could not absorb them, and by the beginning of Britain's long relative economic decline. The 1956 general strike, when roughly 1.7 million workers across multiple industries struck in solidarity with coal miners in what remains the largest industrial action in British history, represented the climactic expression of the class conflict that had been building since before the war. Each of these episodes of internal conflict consumed political energy, economic resources, and perhaps most importantly, national cohesion at precisely the moments when Britain's relative external position was beginning its long decline against the rising power of the United States. A Britain less consumed by internal class conflict might have managed its relative decline more gracefully, preserved more of its global financial position, or negotiated its transition to junior partnership with the United States from a position of greater internal strength. Instead, Britain entered the mid-20th century, the period of decisive reserve currency transition documented in earlier videos in this series, as a society whose internal order had been significantly weakened by decades of unresolved class conflict, just as its external position required maximum coherence and capacity. It's worth pausing to examine precisely how internal political conflict translates into weakened external and economic position, because the mechanism is not obvious and deserves careful explanation. The first channel is fiscal. A society engaged in intense internal political conflict over the distribution of resources finds it dramatically harder to make the long-term, sometimes painful fiscal decisions that sustaining a dominant economic and military position requires. Tax policy becomes a battleground rather than a technical question. Long-term infrastructure and military investment get sacrificed to short-term political considerations. Debt accumulates not because of careful strategic calculation, but because raising taxes or cutting spending becomes politically catastrophic for whichever faction attempts it. The second channel is institutional. Functioning institutions, courts, civil services, central banks, regulatory agencies depend on a baseline level of public trust and political consensus about their legitimacy to operate effectively. As political polarization deepens, institutions themselves become contested terrain. Each political faction increasingly views neutral institutions as captured by the opposing side and seeks to delegitimize or capture those institutions rather than accept their authority. This dramatically reduces the capacity of the state to execute coherent long-term policy, regardless of which faction holds nominal power at any given moment. The third channel is human capital and social cohesion. Sustained internal conflict diverts talent, energy, and resources away from productive economic activity and toward political struggle. It erodes the social trust that allows complex economic cooperation between employers and workers, between regions, between social classes to function efficiently. And in its more extreme manifestations, it can drive emigration of the most mobile and economically productive citizens, who choose to relocate to societies with greater internal stability. The fourth channel, and perhaps the most directly relevant to the themes of this series, is financial. Sustained internal political conflict signals to global capital markets that a country's long-term governance trajectory is uncertain. This uncertainty translates over time into higher risk premiums on that country's government debt, reduced foreign investment, and, in the most severe cases, capital flight, as both domestic and international investors seek jurisdictions with greater political stability and predictability. This fourth channel connects directly to everything this series has covered in its previous chapters. A bond market already under stress from unsustainable debt levels, as documented in the first video of this series, becomes considerably more vulnerable when investors must also price in the risk of sustained internal political dysfunction. A currency already facing structural de-dollarization pressure, as documented in the fifth video, becomes more vulnerable to loss of confidence when the country issuing it appears unable to govern itself coherently. Having established the historical pattern, the natural question is where the current American situation sits within this framework, examined with the same historical rigor applied to the Dutch and British cases. Political polarization, as measured by a range of academic and survey-based metrics, has been on a documented, sustained upward trajectory in the United States since roughly the 1990s, with measurable acceleration in the past decade. Surveys tracking the percentage of Americans who view the opposing political party, not merely as wrong on policy, but as a genuine threat to the country's well-being, have shown substantial increases over this period. Measures of legislative polarization in Congress, the declining frequency of bipartisan legislation, the increasing predictability of party line votes show a similar trajectory, with congressional polarization by some academic measures now exceeding levels last seen in the years preceding the American Civil War. Though the comparison requires important historical caveats about how such measures are constructed. Trust in major American institutions, Congress, the media, the presidency, organized religion, public schools, the medical system has shown a broad sustained decline across decades of survey data, with particularly sharp drops in trust toward government and media institutions specifically. Wealth and income inequality, as documented in detail in the fourth video of this series, has risen substantially since the 1970s, reversing several decades of relative wealth compression that had characterized the mid-20th century. This is precisely the pattern Dalio's framework identifies as a leading indicator of internal order stress, and it connects directly to the debt cycle dynamics documented throughout this series. None of this data, examined individually, proves that the United States is following the Dutch or British historical trajectory toward internal fragmentation severe enough to meaningfully weaken its external position. Correlation across these metrics does not establish that the underlying mechanism Dalio identifies is necessarily operating with the same force in the current American case as it did historically. But the historical framework gives us a specific and falsifiable lens through which to evaluate the data, rather than treating political polarization as simply a cultural or media phenomenon disconnected from the deeper economic and historical forces this series has spent 5 videos documenting. It is worth examining with appropriate historical caution what the most extreme historical expression of internal order breakdown in American history actually looked like, not to suggest equivalence with the present moment, but to establish what the far end of this spectrum has historically required. The American Civil War emerged from a specific and extreme configuration of internal order breakdown, a fundamental disagreement over the legitimacy of an entire economic and social institution, slavery, that had become so existentially threatening to both the Southern slaveholding economy and the moral and political coherence of the broader Union that compromise mechanisms which had functioned for decades. The Missouri Compromise, the Compromise of 1850, finally and catastrophically failed. The specific conditions that preceded the Civil War's outbreak included regional economic structures that had diverged so substantially that the two regions' fundamental economic interests were genuinely, structurally opposed, not merely differently weighted. They included a breakdown in the ability of the existing political party system to manage the underlying conflict, evidenced by the collapse of the Whig Party and the realignment of American politics in the 1850s, and they included a series of escalating political and sometimes violent confrontations, the caning of Senator Charles Sumner on the Senate floor in 1856, the violence of Bleeding Kansas, John Brown's raid on Harper's Ferry, that progressively normalized the idea that political disputes might ultimately be resolved through violence rather than through existing constitutional and electoral mechanisms. This historical case establishes a useful, sobering benchmark. Extreme internal order breakdown of the kind that produces actual civil conflict has historically required a configuration of structurally opposed regional economic interests, failure of existing political mechanisms to manage the underlying conflict, and progressive normalization of political violence as an acceptable tool, not simply elevated levels of partisan animosity or institutional distrust, however genuinely concerning those trends may be in their own right. The historical record does not suggest that current American polarization, however serious, is straightforwardly analogous to the specific and extreme conditions that preceded 1861. What the historical record does suggest is that the underlying mechanism Dalio identifies debt cycle-driven wealth concentration feeding political polarization, which in turn weakens the fiscal, institutional, and financial capacity needed to manage the debt cycle, does not require an outcome as extreme as civil war to meaningfully affect a society's trajectory. The Dutch and British cases demonstrate that significant, historically consequential internal order erosion can occur and can meaningfully weaken a society's relative global position without ever crossing the threshold into organized violence. This is the chapter where every previous video in this series converges into a single mechanism. The bond market stress, documented in the first video, driven by unsustainable debt accumulation, is worsened by political polarization that makes the fiscal discipline required to address that debt accumulation increasingly difficult to achieve through normal democratic processes. Raising taxes, cutting spending, or some combination of both, the textbook responses to unsustainable government debt each require a level of political consensus and willingness to accept short-term pain for long-term stability that intensifying polarization makes progressively harder to achieve. The gold accumulation documented in the second video, central banks hedging against currency and institutional risk, reflects in part exactly this kind of internal order uncertainty. Sovereign reserve managers are not merely pricing foreign policy risk when they diversify away from dollar assets. They are pricing the question of whether the country issuing the dollar can govern itself coherently enough to manage its own debt trajectory over the coming decades. The petrodollar vulnerability documented in the third video, the question of whether American security guarantees remain credible, is itself partly a function of internal order. A country whose internal political consensus on foreign policy commitments is fracturing, where sustained multi-decade military and diplomatic commitments increasingly depend on which party controls the government in any given election cycle, presents a less credible long-term security guarantee than one with sustained, stable bipartisan foreign policy consensus. The middle class wealth destruction documented in the fourth video is not merely a consequence of the debt cycle. It is simultaneously a primary driver of the internal order erosion this video has examined. The wealth and values gap Dalio identifies as the central driver of internal conflict is precisely the phenomenon that video documented in detail. And the de-dollarization trend documented in the fifth video accelerates when foreign governments and central banks price in not just the risk of American financial weaponization, but the deeper risk of an America whose internal governance trajectory appears increasingly uncertain and contested. This is not five separate stories. It is one story examined from five different angles that all reinforce and accelerate each other through the mechanism this video has now made explicit. The historical record on internal order cycles offers specific, if uncomfortable, guidance for anyone trying to navigate the current period with clear eyes. The first lesson is that internal order cycles, like debt cycles, tend to play out over years and decades rather than resolving quickly. The Dutch internal fragmentation that weakened the Republic's 17th century position persisted in various forms for generations. British class conflict took from the 1870s through at least the 1926 general strike more than 50 years to work through its most acute phase. There is no historical basis for expecting current internal order stress, wherever it ultimately leads, to resolve quickly. The second lesson is that periods of internal order stress have historically created significant volatility in financial markets, currency values, and political outcomes. But volatility is not the same as inevitable collapse. Britain navigated decades of severe internal conflict without civil war, without losing its status as a major power, even as it experienced genuine, historically significant relative decline. The range of historical outcomes from elevated internal order stress is wide and includes managed gradual adjustment alongside more severe outcomes. The third lesson is that the societies and individuals who navigated previous internal order crises most successfully were generally those who recognized the pattern early, diversified their exposure geographically in asset classes in their dependence on any single set of institutions, and avoided the trap of assuming that because a particular political or economic arrangement had always worked, it necessarily always would. The fourth lesson, and perhaps the most important for the purposes of this channel, is that recognizing the historical pattern does not require taking a side in the immediate political conflicts that express it. The internal order cycle, as Dalio frames it, is not a partisan diagnosis. It does not identify one political faction as the cause and the other as the solution. It identifies a structural, recurring historical pattern that emerges from underlying economic conditions and that has appeared across societies with wildly different specific political configurations and ideological content. Understanding the pattern is a tool for navigation, not a verdict on any particular political position. 5 videos. 5 mechanisms. Bond markets breaking under unsustainable debt. Central banks quietly accumulating gold as confidence in paper promises erodes. A petrodollar system built on a security guarantee now facing its first real military test. A middle class absorbing the wealth transfer that marks the late stage of every debt cycle in documented history. A dollar weapon that may have accelerated the very transition it was built to prevent. This video is the thread that ties all 5 together, because none of these mechanisms operate in isolation. They feed each other, accelerate each other, and converge in the internal politics of the society trying to manage its own decline. History does not tell us how this particular chapter ends. It tells us, with remarkable consistency across 5 centuries and multiple empires, what the chapter looks like while it's being written. The next video in this series will do something different from anything covered so far. It will look directly at the historical timeline of completed reserve currency transitions, mapping out specifically how long each phase took, from first visible crack to final transfer of dominance, so that everything this series has documented can be placed on an actual historical clock. Subscribe, because understanding the pattern is the first step toward navigating it.